Thank you, Ajay, for this opportunity, Ajay. Good afternoon, everyone, and it's absolutely a pleasure to be here this afternoon. Many faces are familiar, it's great to just pick up these conversations that we have had so many times offline. This is a very passionate topic personally for me, obviously for the organization that I represent, and would love to share my thinking on this topic. So it's a very different lens on the topic of agriculture, especially forward looking, and it's a big gap. If you see just the amount of literature that goes around today on the topic of agriculture, be it private sector, commercial literature, or research papers, topics, they're all focused on production, demand. You rarely find any literature that's focused on finance, credit, availability of credit. I had the sort of opportunity to discuss even with Niti Aayog. Professor Ramesh Chand, member Niti Aayog, came out with a report recently, and he touched a little bit on the topic of availability of credit. And I was delighted with that because after a long time in Niti Aayog's report, did I see even a lens on availability of credit, and that to me. So I'll spend a little bit of time today talking about about that and how that is changing quite significantly, at least over the last 4 or 5 years, and how that is likely to change again as we move towards sort of the Amrit Kal period, and also how the current availability of technology and the infrastructure, organizational infrastructures, including collectives, how they are sort of playing a role in the provision of credit as well as addressing risk. So that's going to be my topic, slightly different from what is mainstream generally covered whenever agriculture is being discussed. So this is I think statistics and numbers that everyone is extremely familiar with. I don't need to say much about this, but I still wanted to put up this slide just to give context. Context is very important in framing a discussion. But the last bullet point is quite important. The flow of credit in agriculture is 15 lakh crores. It's still in my mind very, very small. And even when you dive deeper into that, and I'll do that in the next slide, where it goes, to whom does it go to, how much is that sufficient? Those are all very, very important topics. And that leads to, it has several network effects and effects on the small marginal farmer in terms of his or her ability to invest in newer technologies that we've been talking about, in becoming more resilient to climate change, because agriculture is not just a contributor to climate change but also a significant vulnerable, the largest vulnerable section in society is likely to be farmers with climate change. So we not only need to think about how do we bring technology for assisting agriculture to be more climate friendly, but also help the participants in that economy be more climate resilient. So if you just look at Kisan Credit Card, KCC, as being one of the primary sources of agriculture credit to small marginal farmer, and again I won't reel off some of these statistics. It's all in publicly available information, RBI reports, government reports, etc. The number of farmers who have access even within the KCC domain, and the KCC domain itself is very limiting because it covers only landholding farmers. It does not cover tenant farmers, and that's a topic that is a very different topic altogether. So I don't think as a country we have yet solved and put enough attention on solving availability of credit challenges or even larger challenges for tenant farmers. I'll just take a credit lens. So even notwithstanding the challenges associated with tenant farmers, even looking at landholding farmers, the amount of credit as well as the number of landholding farmers who have access to credit is significantly insufficient to meet just day-to-day survival. It's not even investment in their own businesses to become future-proof, but just basic survival, making ends meet, is an extremely challenging phenomenon. I have worked for a large period of time in the microfinance sector, and I continue to do so. Microfinance does move the needle slightly, does attempt to solve that problem slightly. But the problem with microfinance is that it's a one-size-fits-all product. It scales very well. Standardization scales, obviously. So hence, microfinance has scaled quite significantly. But it is a very generic product. It's a standard group loan product, with a very specific quantum of loan given to a particular individual, and that is a general purpose loan. It's not programmed credit, so to speak, so not allowing a household to specifically make investments in livelihoods or economic activity. So it has made a difference to consumption smoothing within households. It has not allowed the households to move to the next level of making livelihood investments in their business. So while microfinance has moved the needle a bit more, a lot more needs to be done to build customized credit products with both suitability of product to the customer, with the borrower, as well as quantum sufficiency. So both are fairly challenging. The other thing is that most of the agricultural credit is typically perceived as crop loan, working capital crop loan, which of course is a very important part. But today's households, and we heard that even in the fantastic speakers that we've had earlier, that rural households, agricultural households have been traditionally and continue to be fairly diversified. So allied agriculture plays an extremely important role in an agricultural household, in a typical rural household. And a lot of the credit products and the credit distribution and credit delivery fails to recognize the allied agri component of the household, because the narrative tends to be crop loan. Working capital crop loan tends to be where the focus is. But if you look at the household, and if you combine all of their economic activity in a household, in my mind it's an extremely entrepreneurial household, fairly diversified, lots of activities, lots of activities that potentially solve for the volatility of agricultural earnings. Because for example, almost every second, third rural household does backyard dairy farming. They'll have between 3 to 5 cows, buffaloes, etc. Hen, chicken, all of that, goats. So all and output from that economic sort of income coming out of those activities is less seasonal in nature. It's more consistent across the year, makes the household more resilient. So if delivery of credit factors in that nature of the household, the supply of credit will flow faster, will flow more evenly, and will be more sufficient to meet the needs of the households. So that's another sort of, as I said, allied agri receives less than 10% of the total agricultural credit, which I think is a problem, because that's not reflective of the households. Households are allied agri in nature, in general. This is based on some real examples, real sort of work that I've been exposed to in the market. Only about 30% of all farmers borrow from formal sources, which doesn't mean to say that informal sources are bad. Informal sources play a very important role in making credit available. However, informal sources are expensive, and they come with conditions attached, as we all know, and those conditions may not be favorable. While they are very timely of delivery of credit to the farmer, they do come with strings attached, and those strings attached don't necessarily work in the best interest of the farmer. So it is extremely important to increase the share of formal credit to the agrarian household. The second point is most of the agricultural credit does go to medium and large farmers, and hence the SMF, small marginal farmer, continues to be an extremely underserved borrower in the financing ecosystem. More than 50% of the farmers are unable to borrow from any source, forget formal, informal, any source at all. So it becomes very challenging for them to meet, just run a household agrarian enterprise for them. So this is the context that I wanted to sort of speak about, and make sure that we are sort of familiar with that context. And I'll tell you why I'm more optimistic going forward as compared to the sort of the bleak past as far as agricultural credit is concerned. I feel there are a few, and there are lots and lots of initiatives and trends that are shaping the development of the current ag tech or fintech sort of industry. But specifically in the context of agriculture, I think the development of digital public infrastructure (DPI). Again, Ministry of Agriculture, Government of India is talking very keenly about the agri stack, and a lot of efforts have already been made towards building layers of that agri stack. Much of that is in POC mode, proof of concept mode. Hopefully, we will see some real concrete industrial strength solutions coming out of that. But I do believe that things like identity, the standard JAM Trinity, which is the account, Aadhaar, as well as mobile phone, is slowly and steadily making a significant transformation in terms of making credit available to the small marginal farmer. What I'm also very bullish about, and that has come about in the last 3 years, 2 to 3 years, is regulations from Reserve Bank of India which encourage partnership-based lending, which is called co-lending. And the Reserve Bank has come out with very specific guidelines that encourage that, which basically means that it's not just the responsibility of banks to deliver credit, but there could be very dynamic partnerships between ag tech companies, ag fintech companies, fintech companies, NBFCs, MFIs, and banks, because banks are clearly where the wholesale large deposit base sits. But banks don't necessarily have the distribution capability. Their cost structures are very high. They're not nimble enough to reach out to a small marginal farmer. Even the largest banks, in order to meet their small marginal farmer commitments, are buying priority sector certificates, PSL certificates, which is quite a sad state of affairs. It's just the reality. They're unable to source. They're unable to create a nimble, agile sourcing team, sales team that can source small marginal customers, which is where RBI obviously had the foresight to launch some of these new regulations. So I'm very bullish about that because that then brings about partnerships between agile fintechs who can then partner with large banks who have wholesale balance sheets, and those partnerships can bring about significant delivery of customized, personalized credit solutions at the doorstep of the small marginal farmer. It's still early days, but I remain quite enthusiastic about those possibilities. I'm also very bullish about collectives. And of course, FPOs are one form of collectives. There are many others, and there is the current track record associated with collectives. I'm sure we'll all acknowledge that it's a mixed bag. There are some successful collective models. There are others that are work in progress, and many others that are not living up to their sort of expectations. But I continue to believe that a lot of innovation will happen. More models will emerge in the area of collectives, and they do have a role to play in access, last mile delivery of services, not just credit services, but agricultural extension services and many other delivery of services to the farmer. I do think that we are at version 1 of the evolution of collectives in a newer format. Obviously, we had the cooperative, which was truly the version 1, but in a newer format, which are sort of more modern day companies. We are certainly in a version 1 of that, and we will see over the next 20-25 years a lot more evolution of these models. And I'm personally very bullish on those models, and there is a need for us to watch that space, encourage them, at times remain healthy critics of that model, but in most parts would prefer to be very supportive of those emerging organizations and see what we can do to help them move along and become more sustainable and more scalable. I'm also very bullish about new technologies, and there are some very specific use cases, and I'll talk about some of them. I've had some experience in bringing some of these technologies to very specific use case. Shiv talked about remote sensing, AI, imaging, and some of that, although has remained truly 100,000 feet above the ground in more ways than one, but in other cases they have actually gone down to ground level. We work with companies, for example, who have turned that data into sort of proxy credit scores for farmers, and credit delivery against those credit scores is now happening. And I have some real experience to observe that this is not just fictional anymore. This is not just a figment of imagination. This is real credit being delivered with default rates that are now being seen evidenced in the industry, which are lower than traditional bank backed credit flow. So I'm personally very bullish about this, because this goes down to underwriting a farmer at a very specific farmer level, using relevant data. So this is now creating digital trails of farmer activity, where traditionally providing cash flow based credit was not possible, because banks didn't have and still don't have a balance sheet or annual accounts, etc., on the basis of which credit can be delivered. But some of these technologies are now really very specifically bringing that access. More importantly, or equally importantly, banks are sitting and taking notice, and saying that this is a worthwhile program, and let's put our lending programs and let's align our lending programs against some of these technologies. I have first-hand experience with this, and this is specifically something that I'm very bullish about. There is a lot of private sector, venture capital, private equity investment going in remote sensing and what is called as sort of satellite technologies. There are young startups that are emerging. A lot of investments is going in that area, and that applied in the specific context of agriculture holds a lot of promise to me. And I see a lot of development happening in that area over the next 15-20 years to get down to specific small marginal farmers. It also potentially could solve for tenant farmers, because this is not necessarily linked to land holding, it's linked to activity, which is also why I'm very bullish about this use of technology, because it's not basis ownership of land, but it's basis activity on the farm. And once you talk about activity of the farm, you can extend that logic to even tenant farmers. And that's, more than half our farmers are tenant farmers. So we need to find a solution for that. So this is something that I'm just using some examples of what I'm seeing, what I'm experiencing to project out a state for the future. This is another one for insurance. I talked about credit delivery, insurance. Today, the crop insurance program has reached far and wide. However, it has some challenges. It is being innovated as well. However, much of it today depends on the crop cutting experiment. The crop cutting experiment produces basis risk, which means that much of it is assessing damage at a block level, and hence it is not assessing damage at a farm level. So there could be farmers who have damage at the farm, don't receive payouts. There could be other farmers who have not had damage on the farm but receive payouts. So we do need to go down to highly personalized, customized insurance programs. Today, imaging technology, picture-based insurance, you take a picture on the smartphone and you run it past underwriters in an insurance company, and we have run pilots on that with IFPRI and HDFC Ergo as an insurance company. They're working very well. Payouts are happening very quickly. Of course, these are still pilots, and they need to be scaled. But I do believe that solving for insurance for a farmer is as important as solving for credit, because that is how the farmer can mitigate his or her risks associated with cultivation. And if we can't find credible insurance products, that risk will be taken up either by the producer, which is the farmer, or by the lender, both of which are unhealthy, because at some point in time they will stop taking those risks, which is what we're seeing. So we do need to see emergence of world-class insurance products to mitigate some of the risk products for small marginal farmers. And I am bullish. We are in early days, but I remain enthusiastic about the possibilities in this. The challenge, of course, is when the government programs, large government programs like Pradhan Mantri Bima Fasal Yojana, crowds out in a way private innovation, because if it's available in such a large quantity, it basically, the farmer, you go to the farmer and say, but I have registered for PMFBY. Why should I take your product? But the PMFBY product doesn't work as effectively as it should. So in a way, we should find ways in which we can partner with government and coexist. Private sector innovation can coexist with existing pre-existing government programs. Very important. Otherwise, government can crowd out, state can crowd out, private sector innovation, which is one of the classic problems in agriculture. In any case, in general, it is a challenge. This is another example for cattle, where today muzzle technologies have created Pashu Aadhaar. So, like all of us have, Aadhaar based on human fingerprints, retina scans, etc. There are now technologies that have been built to create unique digital identities for animals. And those can solve a lot of problems to create insurance products that are much more trustworthy, much more scalable. Because today the cattle insurance penetration is 4%. Only 4% of cattle in India are insured today, which is a problem, very big problem. One of the reasons why only 4% of cattle are insured is because insurers are afraid and skeptical about the risks associated with the identity of that animal. Today, the identity of the animal is an RFID tag, which is put on the ear of the animal, which is operationally hazardous. The tag can fall off. The tag can be replaced from one animal to another animal. I know of farmers who have actually, most unfortunately, even cut the ear of the cow in order to remove evidence of the tag. Right. So in this kind of environment, no insurance is going to go full in and say we will provide insurance cover for this sector with so much risk. But now digital identity for cattle is emerging, which is tamper-proof, and which is sort of a single source of truth for identity, etc. So these emergence of these technologies also makes me very bullish about potential for solving cattle insurance at scale, and this is already happening today. This is not yes, they are small scale experiments, proof of concepts, pilots, will scale over time. But I do want to sort of talk about that and make sure that we as stakeholders can support some of these initiatives. So really, this is what I wanted to talk about. As a combination, I just want to summarize my talk by saying that the context of insufficiency of credit at small marginal farmer is a very risky and a downhill slope for us to be worried about, because this is not great for climate change and not great for the food demand, etc. So we do need to solve for that. I am bullish about the future, because emergence of technologies, emergence of newer collectives and organization structures, fintech, agtech, partnerships with large companies like the ITCs and like the large banks, those partnerships are being evidenced today. Those partnerships will scale over time, and we need to sort of encourage those partnerships. I do feel that this innovation is poised for now moving beyond pilots to scale, because that's really the proof of the pudding, is when they move from pilots to scale. And I do believe that the next 10 years we will see a significant amount of scale in this sector. So just Ajay, your first question was on customers and will the banks lose out customers? Yes, I mean that is going to happen, but I don't see that happening at a large scale. The reason is because given the subsidy that large banks have from government on deposits, they will continue to have competitive advantage on the deposit side, which the fintechs won't have, which means that the partnership between a fintech and bank is probably a better scenario to go in the future, which means that it is the fintechs will bring customer sourcing, distribution, agile, digitally savvy distribution, whereas the wholesale balance sheet, which has subsidized deposits, will continue to come from banks, and for time to come that is going to happen. So I don't see that really happening. On your point about sort of landless farmers, etc., Khet score, absolutely, these are the this is early evidence of those. Khet score is your alternate CIBIL score. In a way, it doesn't rely on whether you have land or not. It relies on whether a farmer is a productive cultivator, an economically viable cultivator or not, and hence a credit can flow, which is also delinking land ownership because it's focused on activity. So these are some of the models that I think provide some cues for the future in terms of answers. So yeah, I do think that will happen. On your question, ma'am, on behavioral models, I think it's still very, very early days. There are lots of risks. Digital lending is still a very drop in the ocean in terms of the overall supply of credit. So I think we just have to, wait and see. But I do agree with the risks that you have sort of, articulated. And it's very early days. So I don't think there'll be models that will rely 100% on behavioral patterns. I think they will complement existing underwriting capability, and the underwriting capability will have to continue to rely on cash flow. Right? Does the farmer have the ability to repay? The willingness to repay may come from some behavioral analysis, but the ability is down to fundamentals of business. I think that's a very good question, and lending models that are purely based on bureau score, which is things like CIBIL score, are bound to create these outcomes, which is that everyone will focus on the 600 plus customer, and that customer will become over leveraged over a period of time because everyone is chasing that. So you're creating sort of what started off as a virtuous circle then becomes a vicious circle, and hence lending models, bureau score has to be but one input, not the main input. You have to go back to the basics of, does the borrower have the ability to repay? And that the CIBIL score is not. CIBIL score is only showing repayment. Repayment is like musical chairs. So as long as music is running and people are moving around chairs, once the music stops, that's when the crisis starts. So I think focus has to be on first to understand whether the borrower has the ability to repay. Does the business justify taking on debt and repayment capacity, and then CIBIL scores can supplement, or bureau scores can supplement, but they cannot be primary. All lending models that use primarily bureau scores will over time fail, in my view, personally. But my only experience is that the more customized an indicator is, the better it is, rather than more generic with tons of data. 100 data points in a single indicator is not useful to anyone, doesn't have a use case. That's been my experience. So highly specific, few data points, use case driven is my bias, and that's just my experience.